My name is Cynthia Defazio, joined today by Kevin Deitrich and Joe Deitrich of First Choice Financial Services Incorporated. To our viewers at home, do you think about how important it is when you're saving for retirement? It's a lot like planting an orchard. Well, where I'm going with that, it's so important the type of soil that you choose as well as the type of tree will make a difference how much fruit you have when it's time to enjoy that fruit. Well, it's the same with retirement. You want to make sure that you're choosing the right soil and the right seeds to plant so that you can enjoy a bountiful harvest in retirement. I'm joined today by Joe and Kevin of First Choice Financial Services, and we're going to a deep dive into why it's so important to make sure you're choosing the right soil and the right tools for the garden of retirement. So thank you for being with us. Joe, how are you today?
I'm doing well. Doing well. Happy to be here. How are you?
I am doing fantastic.
Yeah,
Thank
good.
you so much. Kevin, how are you?
I'm doing wonderful. How are you guys?
I am fantastic. I'm excited because the setup of this show makes me want to go home and start gardening.
There you go.
I'm like, I'm
right.
ready to pull out the soil and all of the tools. And Joe, when you think about it, obviously, like so many people, when they first start saving for retirement, let's say they're working and they're just tucking money away, they don't think about the importance necessarily of what type of account they're saving in, just as long as they're saving in general.
Right.
But I should ask you, Joe, how important is it to make sure that you have the right retirement account right out of the gate?
Exactly. This is a great analogy, right? Whether you driving down the road in central PA and you see an apple orchard or there's cherry trees or the many cornfields, what we plant is what we're going to reap, right? And
Yes.
so let's be intentional as to where we're putting our seeds, our investments. And we sometimes talk about asset allocation, you know, what we're investing in, but asset location is super important as well. So we want to make sure, especially early on, that we're being intentional to choose what type of accounts and how they are taxed and how that's going to impact how we get our money out. I mean, that's going to be a very big difference of whether I'm taxed on an IRA money or no tax on a Roth money, or how I might be uniquely taxed on a brokerage or non-qualified account that has its own rules. So there's multiple ways of doing this.
Yes.
And we want to be able to know what it is that we can expect later down the road based upon what we're planting today.
Most definitely. So again, tax-deferred, tax-free, and taxable accounts, all of those take into consideration when you're planning your retirement, your harvest, if you will. Kevin, I should also ask you a question. How should someone in central Pennsylvania think about their career stage when they're selecting retirement accounts? Because so often there's no guidance there whatsoever. So talk
Sure.
about the different
That's really,
stages.
Really important. Early in your career, we need to focus on flexibility and growth. Being flexible as far as how much you contribute. Sometimes it might be higher than others, but also flexibility as far as you're getting raises in your positions, you should be putting more money into your 401k or 403b, and we're focusing on growth early on in their career.
Okay.
Mid-career, probably looking at tax deductions and future tax planning when you actually want to retire is really important. And then of course pre-retirement, within that 5 years or so of retirement, income planning, making sure that you have enough income for what your expenses are, and also for tax control. With IRA money, Roth money, as Joe mentioned, there's different tax consequences to both of those.
Yes.
So very, very important that we focus on those. So contribution to 401ks can increase as you early in the career, and then you should be continuing to increase when you're mid-career, and then as you're approaching retirement, you should be probably trying to max out your 401k. That should be maybe a goal of yours. So going from early to pre-retirement, trying to max out that contribution as much as you can each year without really hurting you in the long run.
Yeah, and everybody's situation is going to be different. Their income levels, are you married, not married, what your expense levels are. So your ability to execute on these is going to be different for everybody. Right. Your 401ks, your traditional 401ks or IRAs that are tax deferred, it's going to lower your income that year, certainly. And so, there might be stages, like Kevin was saying, in that mid-career where your salary is as high as it's going to be and you need those tax deferrals. But then other times, perhaps that we need to be trying to get our Roth money in there, and we're not in a tax bracket that's going to be overly burdensome, and so we can prepare for a future tax-free withdrawal on those monies. So everyone's unique, and we want to use all of these tools separately, but combined to get to where we want to be.
It's also important that we have that balance, because as someone's in there, let's say they're 60 years of age and they want to retire at 65, they're putting 20% of their income into 401k, tax deferred, they might need that to offset the taxes because their income usually is higher at that time.
True. Okay.
But you also want to be focusing and probably putting more money into the Roth at that time as well because you want to grow the Roth tax-free. So there's that balance.
Yes.
And where that sweet spot is really based on planning.
Okay.
And so it's really important that you come and talk to us to be able to plan that and make sure we could get you that sweet spot.
And I love the fact that we're talking about tax control because, oh my gosh, what a refreshing thing to know that you can actually control where your taxes will be because you're planning proactively, much like when you're planting your garden, you're watering, you're fertilizing, you're taking care of it, you're pulling out the weeds. You should be doing the same when you're talking about your retirement plan overall. So again, we can't stress that enough. Joe, I want to ask you, what are some common misconceptions that you see with workplace retirement plans? I mean, we could probably spend a lot of time on those 401ks right now.
Well, yeah, and I think we probably already have done an episode that is completely dedicated to this question. How much should I be using my 401k? You know, and years ago, everybody had a pension, and we didn't have 401ks. And then 1978, there was an act that birthed the ability to have that 401k, tax code and allowed us to create the 401ks that we know it. We all overnight became investment managers of our own retirement accounts, right? Which is great, and they're a great tool, but they're only a starting point.
Yes.
We might be getting company matches, but we want to be careful not to solely rely on that account. Particularly later, our tax consequences are going to be a little bit challenging. It makes me think of a couple that we've recently met with where good earners, they were married, Bill and Nancy were married, and Nancy was a little bit older and she got the chance to retire and Bill loves his job and he wants to continue to work for another 5 or 7 years, right? We see this kind of situation all the time.
Okay.
But they've relied heavily on their 401ks and they've done a great job of saving. They've got a great nest egg. However, they're a little bit handcuffed because we only have one type of account. We have a traditional 401k. Which means every dollar that comes out of that account is going to be taxed as income at whatever income rate they are.
Wow, okay.
We have an opportunity right now because as she's retiring and we've got the One Big Beautiful Bill Act, there's some tax changes there. Now we're having an opportunity, we're looking forward, how can we maybe diversify those tax accounts? Maybe how can we get some Roth money involved in there? Should we be maxing out the 401k this late in the game? When we don't necessarily need to grow that anymore? Should we be maybe saving that in a taxable account?
Yes.
So we need to be looking at that and looking forward. We can't control exactly where we've been to now. So, the best time to plant a tree was 20 years ago. The second best time is right now. So let's start where we are and see how we can get towards our goals.
Most definitely. So just like when choosing the right soil, we have to figure out taxes in there to make sure that when you're at the end of the retirement journey or just beginning it, if you will, you have the right harvest. You have enough fruit to pull from, enough vegetables coming out of your garden. I'm really running with this gardening thing. Can you tell?
It's fun, right?
It's so much fun.
Yep.
Right.
To our viewers at home, there's a number for you to call on your screen. That number is 888-959-2743. Excuse me, 888-959-2743. What you're calling in for today is a complimentary consultation with Kevin and Joe. Let them get to know you one-on-one. They're going to ask you a lot of questions about what are your hopes and what are your dreams. They want to spend the time to get to know you. This is not going to be an appointment where you're rushed in and rushed out. This is time that you're going to actually be heard and listened to, the most important thing, especially when it comes to retirement planning. You want to be able to voice your concerns. What you will leave with is knowledge and power, and you can make the decision that's right for you for your retirement plan. Again, that number is 888-959-2743, or we've made it even simpler. You can grab your smartphone, click on that QR code at the bottom corner of your screen. That's the fast track to get on the schedule of First Choice Financial Services Incorporated. What you'll receive, of course, is your complimentary customized retirement plan that will be designed just for you. No cost, no obligation. Just one thing required. Pick up the phone and call in today. We'll be right back momentarily. Don't go anywhere.
One of the reasons people hesitate to come in is because everything looks so confusing. They just want to do what they have to do and get retired. Well, having someone who knows what's going on, been up the mountain a few times, and down, we can take the things that you're overwhelmed with that are so complicated for you, things that you don't see how that needs to be done or why it needs to be done. We can take all of those things and we'll go ahead and break it all down, simplify it so that you know how to answer those questions. And when we're all done and we put that plan together and we review it with you, now we may revise it 3 or 4 times, but when we first review it with you, everything's crystal clear. And so now you have a lot more confidence to go ahead and with your second meeting with us and your third meeting, because now we're going to take those individual concerns and we're going to talk about them. And how do we fix this? And then here's 2 or 3 ways that we can do it. Which one appeals to you? And the next one and the next one. So, there's no reason why you have to fear retirement. There's no reason why, you have to go into that feeling so uncomfortable. Just come and see us. We'll sit down, we would love to talk to you, and we'll simplify that for you so that you feel like you're in charge again.
Welcome back to Mid-State Money Talk. My name is Cynthia Defazio, joined today by Kevin Deitrich and Joe Deitrich of First Choice Financial Services Incorporated. And we're talking all about the importance of understanding what types of accounts you have, how they will be taxed, and how you can enjoy a bountiful harvest in your retirement years. It's so amazing to me when you think about it, Kevin. Obviously, we're talking about so many different things that people need to be aware of when it comes to planning their retirement. Taxes is such a key component. Can you break down the key differences between traditional and Roth retirement accounts? I think the viewers want to know that for sure.
Yeah, we definitely talked about that last segment as well.
Yes.
And the difference between traditional and Roth, or like a 401k traditional IRA and a Roth 401k. The traditional is a pay tax later type of account. So it's gross tax deferred. You put the money in, tax deferred. It grows tax deferred. When you pull the money out, as far as income or withdrawal, it's taxable. The gains are taxable in that case as well. Tax now is the Roth. So when you put the money in, it's off the net of your check. So it's a taxable event. And then as it grows, it also grows tax-free, which is really, really nice. There's also future tax rates which have uncertainty. So it's really important that we can try to get some money over to Roth. Even from a traditional standpoint, if you have an IRA, we can convert some of the IRA money over to Roth. Because we know what the taxes are now, we don't know necessarily what the taxes are later.
That's true.
So it's really important that some of that Roth conversion might happen even pre-retirement.
It's like you're playing a game where the rules are unknown, but right now they are known. So it makes sense to take action when you know what's happening. So I love that,
I actually
Kevin.
have a story that I have a client that, we'll just call them Will and Wendy, okay? The two W's, Will and Wendy.
Okay.
They came in, they sat down, we put a plan together for them, and it went really well. We started doing some Roth conversions, taking their existing IRA money and moving it to a Roth over time. Just chunks at a time to stay in the same tax bracket that they're in, so they're not paying more tax than they need to. So we're controlling the tax on that money. So over time, maybe a year or 2 later, Will calls me up and says, Kevin, I need a new truck. I said, okay, that's not part of the plan, but we can make that adjustment. And so we come in, he comes in, we sit down, we pull some money out of the Roth and some money out of the traditional IRA to equal what he needs for the truck, and we control the tax on that purchase.
Wow.
So he was really happy. Years later, he calls me again and says, Kevin, I want to buy a vacation home, which we'll talk about that later.
I was going to say, okay. Thank you. I can't wait. I'm curious now.
Yeah.
But we can make adjustments.
All right, excellent. So when you think about it, how important is it, Joe, for tax diversification for retirees in central Pennsylvania? Talk a little bit about that, tax diversification.
Yeah. Well, I think Kevin hit it right on the head with that story, honestly. How many of us, when we think, well, once I retire, nothing new is going to happen, right? There's not going to be any surprises, not going to be any bumps in the road, and that's certainly not true. I mean, just hear what Kevin just said. And tax diversification is exactly what Kevin was talking about, is allows us to adjust to those unknowns, right? So being able to go into our various accounts and select how we are going to withdraw our accounts and how that money is going to be taxed gives us the flexibility and control. I always say you're going to have the most control over your tax return than ever before in retirement if you plan ahead. And so that's why it's important to come in, sit down, and talk with us, because we want to review the entire plan. We want to talk about your goals, your dreams, what's it going to look like, so that we can start planning for that, and we can add some control back into those plans.
Yes. And again, I love to highlight the fact that these are customized plans. As you can see, it's not a cookie cutter approach for retirement. This is not one size fits all. This is your life. You've worked all your life to get to the retirement years. You've earned the dollars. You need to have control with how they're spent. So Kevin, I want to ask you a question as well, if I may. How do required minimum distributions impact retirement income planning, those RMDs, if you will?
Required minimum distributions,
yes.
they definitely can impact retirement. We actually had a couple come in from Mid-State Money Talk. They were called in and spoke with us, and we sat down. And he was the VP of a major corporation in our area, and he has a huge pension, and he has a huge 401k.
Okay.
And so we ran the numbers. We put a plan together for them, and we realized that he'll be having to take almost $100,000 out of his accounts at RMD age.
The beginning of RMD age.
Correct.
And then it avalanches beyond that. Yeah.
Oh, wow.
Yeah, sorry.
So we ran the numbers on, does he take the lump sum pension or does he take the monthly pension amount?
Right.
So those are all factors that we have to consider. What's the best course of action? Because not only does the RMD, when he takes that money out, kicks him into another tax bracket, it could kick him into a Medicare higher tax rate, payment rate on that as well.
Wow.
So there's a lot of factors that go into RMDs. People don't realize that when you're required to take money out of your IRAs, if you have not done the proper planning and you have a huge 401k or a huge IRA, that you'll be paying money on a lot of tax on that money coming out, which will kick you into another tax bracket.
Wow.
It will also increase your monthly Medicare Part B and Part D payment.
Oh my gosh. That can be scary for people.
So this planning is really, really important. People just say, oh, RMDs, well, I'm going to need that money anyway. Well, maybe.
Yeah.
You might need that money. You might not. If you have a nice pension and you have a nice Social Security check, you might not need the money at that time.
Right.
So very good. It's really important to have proper planning on that.
Yeah,
Yes.
and I think a lot of times we underestimate what our accounts are going to do. We don't want our accounts to sit stagnant. We want to see them grow.
Correct.
So the amount of money in your account now, and say you have 7, 8, 10 years until your RMD age, well, that money could be, double, or, maybe that'd be great if it doubled in 5 years, right?
Right.
But it's certainly going to be larger than it is now if we're taking care of it properly. So what you think that your RMD, I can handle that amount, that's not that big of a deal. Well, what if your account is twice the size it is now?
Exactly.
Right? So it compounds. And then your RMD factors change as you get older. The amount you're required to take out goes up and up and up.
Correct.
So sometimes those initial years of RMD age, they don't think, that's not that big of an amount. I think we can kind of manage that. But wait until it starts getting a little bit larger. And it's almost like an avalanche, right? You hear the crackling,
Yes.
the snow starts to come, and then all of a sudden it just pours in.
Yes, people need to actually have control of this, because it can be very scary if it's the unknown and all of a sudden you're hit with these huge tax burdens, if you will. Gentlemen, thank you so much. To our viewers at home, you're being offered the opportunity to call in today and to book your complimentary consultation with Kevin and Joe. That number, 888-959-2743, 888-959-2743. We're spending a lot of time today talking about how your different accounts can be taxed. Well, wouldn't you want to have control of that in your retirement years? Think about that again. You've worked your entire life. This is your nest egg that you've amassed. You want to make sure that you can control where you are and what the direction will be for your retirement dreams. Well, how do you take that step? Once again, you call in to 888-959-2743, book that complimentary consultation, or grab your smartphone, click on the QR code at the bottom corner of your screen. That's going to be the fast track to get on the schedule of First Choice Financial Services Incorporated. We're going to take a very short commercial break. Don't go anywhere. We have so much more talking about your bountiful harvest when we return.
According to a Transamerica Retirement Survey, over 1/3 of American workers have already dipped into their retirement savings to handle day-to-day expenses, and nearly 40% have reduced their contributions. For those approaching retirement with significant assets, this may sound like someone else's problem, but it's a warning worth noting. Economic pressure doesn't discriminate. High net worth individuals are just as vulnerable to reacting emotionally during times of financial stress. The key is discipline and a plan that evolves with changing circumstances. Having a tax-aware, income-focused, and flexible strategy in place can help you avoid short-term mistakes that impact your long-term goals. Because real success in retirement isn't just about what you've saved, it's how you protect it and use it.
Welcome back to Mid-State Money Talk. My name is Cynthia Defazio, joined today by Kevin Deitrich and Joe Deitrich of First Choice Financial Services. And we're talking all about proper tax planning in your retirement. We're talking about how you can have a bountiful harvest. These are seeds that you've planted. You're going to want to nurture them and watch them grow. But when it's time to take that fruit and enjoy it, you want to make sure that you can keep as much as possible and not share too much with Uncle Sam, let's be honest. So Joe, let me guide this to you if I could. How do retirement account choices affect monthly income in retirement? I know a lot of people are also thinking not only about themselves, but legacy. We're going to talk about that too. Yeah. But specifically, how do retirement choices affect monthly income in retirement?
Absolutely. Nothing happens in a vacuum. So our choices in what accounts we're investing in ultimately is going to determine how we get our income in retirement. Social Security is not meant to be your sole source of income. That's going to be one pillar, but we're also going to need to supplement that some other way, right? And so whether that's our brokerage account or our 401k or some sort of guaranteed lifetime annuity, whatever that might be, the way that it's taxed is going to be dependent on how you're investing today. And so how do we layer an income plan for you that makes sense, that's tax efficient? But we also want to think not only of when we're married, right? Not only what it looks like today, but what happens if you or your spouse pass away? What happens to those income sources? What happens when you go from a married filing jointly to a single tax filer? These all impact how much Uncle Sam's going to share in your retirement accounts. So how much do you want to share with Uncle Sam?
Exactly.
We want to make sure that we can forecast as best as we can and make some plans for those eventualities.
Absolutely. So if you're going to make a big apple pie from your orchard, you want to make sure you give them a tiny sliver if you can.
There you go.
Right?
That's right.
No other way to look at
Just
that.
the crumbs on top.
Yeah, exactly. We're going to do something, but okay. But Kevin, let me ask you a question. What role do retirement accounts play in estate and legacy planning? I kind of tuned into that a little bit when we were talking to Joe for a moment, but a lot of people are thinking about legacy planning now. So how do they play in estate and legacy planning?
Sure, they play a huge role. I mean, they're the accounts that's going to fund that legacy. I want to preface it by saying that I want to talk in general terms because there's rules on the different account types which we've been talking about, traditional IRAs, Roths. I want to throw another one in there, non-IRA accounts. We can call them non-qualified accounts.
Okay.
There's certain rules for both. If you leave, let's say, an IRA to your beneficiaries, if it's a spouse that you're leaving it to, they can just assume the IRA, and there's no taxability there. If you're leaving it to a non-spouse, a child, grandchild, there's a 10-year rule that applies, that account has to be drained over a 10-year period.
Okay.
So at the end of 10 years, that account has to be zero. Okay, so the IRS does want their money, their tax money on that.
Okay.
If it's a Roth, it's tax-free. That's pretty simple. We understand that. So it's left to the beneficiaries. Doesn't matter if it's a spouse or a child, tax-free.
Tax-free.
Pretty simple, not quite as complicated as the other things, and it's why it's such a powerful tool.
Yeah.
Most
Non-qualified,
definitely.
that's like a brokerage account in the market, or a non-qualified annuity. Those have different rules. If you have the money in a brokerage account, let's say this is in the stock market, it has a step up in value, and then it's just left to beneficiaries, and then they will pay the capital gains as it goes forward.
Okay.
Now, if it's inside of an annuity, you have some different rules there. You have some different options. You can do a 5-year payout, or you can do a stretch, and so you can stretch it out over your lifetime, and the RMD rules apply to that.
Okay.
So I'm saying all of that to say that's a lot of stuff to consider.
Right.
And to understand. So it's really important to have a person that does this for a living, us,
Yes.
that knows how these case accounts should be structured, what's the consequences, what's the results of the tax implications of these accounts. So having a proper plan in place is so important, and having those being proactive in doing that is so important.
Yeah, we
Most
see people come
definitely.
in and they're receiving accounts from their father, mother, grandmother, whatever it might be. So they're inheriting accounts. But it's even better for the people that we're working with, our clients, that we can start selecting what they would like their heirs to receive. And so that's putting that piece of control back into their plan.
Okay.
A lot of times, something that they've inherited will sometimes kind of disrupt what they thought their plan was going to be. And so they see, well, wow, that's really important. I can take some stress off of my heirs by making some proper planning decisions.
Most definitely. So important.
Yeah.
Well, talking about planning decisions, Joe, let me ask you, how often should someone review or update their retirement account strategy? Because so often, I'm sure you're meeting with clients that are thinking, well, gosh, I haven't looked at that in 25 years.
Yeah.
But how often should someone be reviewing their strategy?
Early and often.
Okay, there you go.
Obviously, we want to start with a solid base plan. We want to understand where we want to go. But wherever you are now, the idea is to meet with somebody. If you don't have confidence in your plan, if you don't have confidence in that your accounts are aligned with your goals, particularly with your legacy or estate goals, where do you want that to go when you pass? Sit down with us. Give a call on the screen. It's 888-959-2743. Give us a call. When you sit down with us, you're going to leave with a customized complimentary plan. You'll understand where things are at, what changes you want to make, and what you can expect going forward. So, yeah, now there could be other changes. There certainly could be, you're married, you get divorced.
Yep.
These are major life changes. We certainly want to look at those times, but we're meeting with our clients every year to talk about these things.
It's so important, especially when you think about how tax laws can change, goals change. You have to have regular meetings with your advisor. And so often we've heard people say, I haven't heard from my advisor in like 7 years.
Yeah.
That's a red
Way too
flag,
often.
Kevin.
It absolutely is a red flag. Relationships change.
Yes.
I mean, we see it all the time. Clients come in, they say, well, this child of mine hasn't talked to me for 10 years. I want to remove him or her off of the as beneficiaries.
Yeah.
That's a sad situation.
It is.
But that is reality. And so those things are always changing. And so we have to be flexible. So if you want confidence that your retirement accounts are aligned with your goals and values, schedule an appointment with us.
Kevin, thank you. Joe, thank you. To our viewers at home, thank you for being with us today as we're talking about planting that retirement orchard. That number to call is 888-959-2743, 888-959-2743 to schedule your consultation for the complimentary customized retirement plan. Be safe, be happy, and be blessed. We'll see you back 1 week from today. Take care now. See you soon.